Afternoon, everybody. Thank you all for joining us today on the C Connect webinar. It's the 5th of February, 2021. Before I start, a small introduction to myself. My name is Captain Gur Prasad Kohli, and I was working with the Will Williamson Group for about 32 years. So the first 18 years, I was sailing with them. The first 15 years, sorry. I was sailing with them. And I was a master with them for about 4 years. And then in 2000 beginning, I had completed an MBA from England, and I came ashore as a superintendent in Kuala Lumpur. Subsequently, I held various leadership positions with Wallenius Wilhelmsen and Will Williamson. And I finally decided to call it a day in 2019, at the end of it, and started a second career with sales consulting and business consulting and some financial planning business. And I got myself certified for this. And this is what I do now, primarily focusing on the needs for insurance and pension plans for seafarers. And I try to utilize my own experience as a seaman, as a seafarer, and learn from what all I did and did not do. And also, of course, times have evolved. There's a lot more better products available for us today than were available maybe 10, 15, 20 years ago. So let's start with looking at what are the financial goals for a seafarer. Next, please. So some investment goals will stay constant throughout your life and career. So one of them, the most important one, is the financial security goal for self and your family during your work life and after retirement. So this is a steady goal. Job security and the ability to choose your choice and place and time of work has become very important for the younger generation. So unlike someone like my generation, where it was important to get work and then to kind of stick on with one company, today people like to have the ability to choose when they work, what they work at, and how they work, and how much time they want to spend between work and pleasure. Medical insurance is also something which is a constant throughout your life. And from experience, I can tell you that the earlier you take a medical insurance for yourself, a personal medical insurance, the better it is for you, because you have a much better cover, and that cover can stay at a much affordable rate for the rest of your life. Some investment goals will change during your lifetime. Buying your first home, typically you do that once you have got married or just before getting married. Paying for education and marriage for children, of course, this is a later on in life goal. Pension plans is something you start thinking about once you start getting closer to 50. And discretionary and lifestyle spending, of course, depends on how much money you have to spend. So let's start with talking about insurance itself. Next, please. So why do you need life insurance? Right? I mean, you need life insurance because you are pretty much at the center of your family's financial infrastructure or support system. And if something happens to you, then that whole infrastructure support system, which not only includes just food and shelter and clothing, but also your mortgages and your dreams and your aspirations for your children, everything collapses. Why do we need life insurance? Because a seafarer's life is a very outdoor life. There's a lot of travel, and it's also a very hazardous profession. And while when you're on board, your employment contract and P&I clubs will cover you for life and disability on board, you don't have any cover when you're ashore. Similarly, the cover which you get while you're on board may not be enough in terms of quantum to be able to cover you and your family for a longer time. So it's always a good idea to get yourself an additional life insurance. Why do you need life insurance? Because today it's possible for you to insure yourself at a very, very small cost. And I will show you that in the next slide. And you also get very good rider clauses on your life insurance today. So you get a rider clause for accident, disability. You get a rider clause which covers 69 critical illnesses. You have a rider clause which even covers unemployment. And you have a rider clause for COVID. And these can give you access to funds when you need it most. Insurance premium payments are exempt under income tax rules, as is the payout. And like I said, it's very, very affordable. So here I have given a small illustration. In this illustration, I have taken as an example a 1 crore life insurance for the person who's being insured. And this is for a non-smoker. And the payment term is 10 years. And for a 25-year-old, you pay around $42 a month. A 40-year-old would pay about $105 a month. This is about the same as you would pay for a decent meal in a 5-star hotel. So it's not really a very, very big hole in your pocket, but you have a cover of 1 crore and you can sleep easier at night. Next, please. Now, if I look at the same premiums, it's the same assumptions. The premium now I have taken for a smoker. And for a smoker, you can see the premium has gone up by 1.5 times, but still it remains within a band of $65 to $160 a month, which is still very, very affordable considering the kind of money that seafarers make. Next, please. So that was when it came to life insurance. Now let's talk about retirement and pension plans. Now there are two kinds of retirement and pension plans I'm going to talk about today. The first one is what we call a smart wealth plan. This is a product given out by Max Life Insurance, which I've used for illustration here. And this plan requires you to invest a certain amount of money, for a period of say 10 years before you retire. And then the benefit of this plan is the payout you will get is guaranteed. So, if you put in a certain amount of money, and I'll show you on the illustration later, you will get a certain amount of money for the rest of your 25-year term after the policy payment is finished. You have a flexibility to choose from different plan options in terms of how much you want to pay out, how much you want to pay in for a number of years. You have a guaranteed income for 25 years or 30 years. You have complete financial security in case of death during the premium payment term. So if something happens to you in the 10-year, when you're paying the premium, you are covered. In fact, for 10 plus 1, 11 years. After that, you will get the income, and that income will continue to accrue to your nominee, whoever it is, for the next 25 years. As I mentioned, there's a tax benefit under the income tax rules, so you get a tax benefit. Also, the payout is completely tax-free, and that is guaranteed as per the Indian income tax rules as of today. Another benefit you can have is you can have enhanced protection through optional riders. So let's look at this a little bit more detail. Next, please. So in this particular plan, which I have taken for illustration, you will pay for 10 years. And say, for example, you start at the age of 35, you pay for 10 years, and the payout will start after the 12th year. All right. So click again, Zinia, and year 36, you will get all the money which you had paid in as a premium. So this is a very, very good plan to start when you are young and you have a few years of working life, and you know that you will be able to pay the premium, and you can choose the amount on it. Next, please. Now, I have taken out a small illustration for you. And in this illustration, as you can see, I have taken the age when you start as 35, 45, or 55. I have taken the premium as 5 lakh. You get an insurance during the premium payment term of 11 years. So if something happens at that time, you will have an insurance of up to 84 lakhs. All right. So for a premium of 5 lakhs. Once you finish the term, that 11 years, you will start getting an annual income of 4.74 lakhs every year. All right. So this is an annual income you will get. As you can see, the older you are when you invest, the annual income gets smaller and smaller because obviously there is a higher risk of mortality, which they reduce the income by. Now, at the end of this 25-year period, so for a 35-year-old when he's 71, for a 45-year-old when he's 81, you will get your complete premium back. So whatever 5 lakhs you paid for 10 years, 50 lakhs, you will get that money back. So the return you get on your investment is around 3.3 times, which is a very, very good return. Remember that this is guaranteed. And as per the income tax rules, as of today, this is completely tax-free. So it's almost 20% more in terms of real value than what you would get from a income from a rental or a FD, etc., because those are taxed. Next, please. So the one I talked about is a systemic investment plan for your retirement. Now I will also talk about something called an annuity. Now I have decided that, just now I have managed to get a big lump sum of money, either from my parents, or I got it from an investment, or I got it from a mutual fund, or I got it from sale of property. And I want to invest it in something which will give me a steady income for the rest of my life. So then you have to invest it into something known as an annuity plan. Now, the difference between an annuity plan and the smart wealth plan I told you earlier is that in an annuity plan, you put a lump sum investment, right? So you put the investment once and you choose a deferment period. You can either say, I want the annuity to start from tomorrow, or you can say, I'm ready to wait 5 years or 10 years for the annuity to start. And based on that, your return will be higher. And the annuity does not run for a period of time. It runs for the rest of your life. So if you live till 90 and you put this lump sum at 50, then for the next 40 years, I mean, again, depending on the deferment period, the next 40 years or 30 years or 35 years, you will get the return. At the end of that period, and the other advantage with annuity is it's a joint annuity. So you can buy it with your spouse. So if either one of you leaves earlier, then the other person will continue to enjoy the annuity for the rest of their life. So this is a very good way of putting up a small safety net around your family, that nothing, I mean, they don't come to a stage where they have no money because you've already put the money away. The annuity also works as an endowment because you can put your nominee as the person who will get the annuity after the two of you are not there. And that person would get the annuity at 105%. So for example, if you put 1 crore, then your nominee would get 1 crore 5 lakh rupees at the end of the period. The only drawback with an annuity is that it is taxed at the same rate as your regular income. So the same like an FD, the same like house rental, the same like money from mutual funds or capital gains, you will be taxed at your regular rate of return. So depending on whether you are at a 20% bracket, 25% bracket, you will get taxed for it. But the advantage of an annuity is the simplicity. You choose an amount you can comfortably put away. You choose a deferment period as per your age, and then you have an income for life, as long as you're alive. And it's guaranteed. Next page. So I have a small illustration on this too. Again, I've taken 3 examples. One person invests at 45, another at 50, and another at 57. The two investing at 45 would take a 10-year deferment period. So they are willing to wait for 10 years before they start getting the money back. And the one at 57 takes a 5-year deferment period because he wants the money earlier. The return of premium is the same. For a 1 crore annuity, you get 1 crore 5 lakhs. Your income will change. If you're taking a 10-year deferred and you are 45, you get about 10.6. If you're 50, you also still get around 10.6 lakhs per year, guaranteed. If you're 57 and you have taken a 5-year deferment, then you will get around 8.2 lakhs per year. So obviously, shorter deferment period, the shorter is lesser is your return. During the deferment period, from the time till you get the money, you are covered for anything between 1.1 to 2.1 crores, depending on the period. So you have a death benefit in this. It's an insurance. And whenever you are, your nominee will get the money at 105%. So if you assume that you will live till 85 and you invested at 45, you are getting a return of 4.2 times your income. I mean, what your investment, sorry. If you invest when you are 50, you will get a return of 3.75. And if you invest when you are 57, you get a return of nearly 3 times. So an annuity is an excellent way to invest your money. But the only thing, like I said, is you will be having to pay tax on whatever money you get. Next, please. So just to give you a little bit more information, I am working for a company called Max Life Insurance. And Max Life Insurance, the big advantages of that is, one is that they are present with all across India, more 300 offices. They have the claim percentage, which is the number of claims paid within 1 month of a claim being made. For Max Life is the highest in India at 99.22% on individual policies and 99.5% on business policies. Their conservation ratio, or the number of people who continue to stay with them, is above 85%. And the solvency ratio is 207%, which is a lot higher than the 150%, which is mandated by the IRDAI. So more or less a very, very solid company, and a company which has been in business for the last 20 years and is a very good company with, as a company with very, very good plans. Next, please. So today, what I have done is I have given you all a small introduction to insurance and to pension plans, the ones I feel are very good for seafarers and are useful. If you need more details based on your age and what kind of riders you would like to add on or what kind of cover you would like to have, please feel free to contact me. My email and telephone number is on the screen. And thank you very much for joining us today evening at Sea Connect webinar. Thank you and goodbye.